Welcome back to the investment challenge. Today's topic is the stock screener, and I'm using the stock screener of the Reuters Icon platform. This is a retail version. It's called MetaStock Zenith. It's $110 a month. You can do a lot more than stock screening. But as you should only know that it's not free, but as long as you have a stock screener that has all the fundamental data, you can just copy what I will be discussing today. And we will firstly focus on the criteria that I am using. As you can see here, we have filtered this list for different criteria. We start with the EPS growth. EPS growth is pretty easy. Earnings per share. The earnings per share, pretty self-explanatory, I think. Then you have the revenue growth. Revenue is all the money the company makes, not just the profit. The revenue should also be growing, not just the EPS. Then we have the price earnings ratio, PE, should be greater than 22. Why? It's pretty easy. The market average or the average from the S&P 500 is 22, and I'm only looking to hold the stocks for short periods of time, and for that use I'm just using the stocks to make money. I don't want to invest in them, so I'm always looking for stocks that other people would consider overvalued. I like overvalued because that basically means it this company has more value, in my opinion, at least for the short term, because other market participants are not stupid. So when a company has a PE ratio of 60, then there must be a reason for it, and I just want to use that reason to make some profit in the short term. But I will make a separate video about the PE ratio, of course. Then we have the operating margin. I just like high margins. It's pretty simple. If you have high margins, it's just easier for the company to make money. And most of the time you only have high margins if your product is good, or if you can sell your product for a high price. Maybe you don't have competition for that product. I myself have an agency, and the competition there is getting more and more. So when your service is pretty similar to other companies, you have to drop your prices or make your stuff, your service better. Otherwise, your margins go down. So when I buying stocks, I always look for high margins. So next point is the PE relative to its sector. It's pretty simple, I think. I just want stocks that have a higher price earnings ratio than its sector. Then you have the beta. I will make another video about this. This is not so important for filtering. This is more important to keep in mind when I build my hedging positions. So I will make another video about that. But as I said, it's not so important for the filter. Then we have the price change in the last 3 months. I want that to be positive, just because I like buying stocks high and sell them higher and not try to catch a falling knife. So always buy stocks that are making higher highs. It's just for trading. For investing, I don't know. Don't ask me. Then we have the price change 1 year. This must be positive when the stock didn't make higher highs, or at least some profit in the last year. I think most of the time you shouldn't buy it now. You should wait for some positive price action. Then we have the price change relative to sector. It's basically the same than the PE. I just want that the stock is performing better to the sector, because if it's not, then just buy the index, the sector ETF. But we don't want to do that here. We want to beat the market. So the price action of the stock should be better. Pretty easy to understand. Then we have the estimated earnings per shares for the next fiscal year. And here I just want to see that this number is growing from year to year, because if the EPS is not growing, why should the company stock should be growing? The stock price, why should it be going up? So this must be a growing number. Then here we have the sector. Also not a filter criteria for me at the moment, but you could use it. Maybe you have done your top-down analysis and concluded that it's better to buy more cyclical stocks. Then you can just filter out the defensive ones here. You could just say, okay, here, and then filter out the defensive stocks such as healthcare and so on. I will make a separate video about cyclicals and defensive stocks in another video. Let's see. As I said, a PE ratio must be higher than 22. Operating margins, I think it's over 10. Yes, here greater than 10. Now I messed up I don't know how it's called, the ranking, I think. Okay, let's just leave it there. Then we have the return on equity. I also like it above 10. Yeah, in some cases or in some industries, it could be lower. Maybe let's say 7. You shouldn't be too hard with this criteria, because just this change from what did I just do, from 10 to 7 gave me 50 more options. But you also want to have a list with over 200 stocks, because you only want to trade the top stocks of the market. You don't need to have 200 stocks on your watch list. It's just too much work to keep up with developments of that company. Ideally, I'm looking to have a watch list of about, let's say, 30 to 50 stocks. And that's a number I can keep track of. I can look when the earnings are coming out. That's not a problem, but you shouldn't have 200 stocks in your watch list. This is not your watch list, but this is a screener. But I think you get the idea. Don't make more work. Don't make you more work than you need to. I don't know if this is English sentence, but work smart, not hard. Let's say it that way. So this was the video about the stock screener. Of course, this is not everything to it. When I screen the stocks, I go through a different process to read about that company, to look at the numbers more in detail, but I will show that in another video. This should be enough for now. And as I said, you don't need this tool. You can do it with free tools on the internet. Just copy these options. This is very easy to do, and then you have basically the same results as me. So if you have any questions, just leave a comment, and let's say goodbye for now.